Raul Elizalde with a quick take on the markets. When you look at the U.S. economy, it's pretty clear that things are going in the right direction. Virtually every indicator is pointing up. Industrial production, capacity utilization, retail sales, which are now above where they were before the crisis. Employment is definitely improving too. Housing is the only exception, with prices and sales still hovering along the bottom. But what can you expect? The hangover supply is huge, and it will take quite a while to work itself out. Now, this may take years, but a weak housing sector will likely be less and less important as time goes by. So with all this improvement, investors are coming back to the stock market. Remember, the huge bull market that we had in the last year and a half or 2 years or so happened at the same time that the volume of equity trading was falling. Also, we know that all throughout the rally, people were selling shares of mutual funds that invest in U.S. stocks. But all this changed in December. Equity trading volumes are now up, and people have started to buy U.S. equity mutual funds after many months of selling them. So we have now strong fundamentals and demand of stocks that is aligned with those fundamentals, as well as a momentum of prices going up. This is a good sign. When everything is consistent and pointing in the right direction, this is a strong indication that even higher prices are possible. So what could go wrong? Well, two things are important to focus on right now. Domestically, the big concern is on municipal bonds. States are strapped for cash. They have no flexibility because by law they have to balance the budget every year. Articles have been dissecting the local government finances and are popping up all over the media, which makes it seem that the reason why muni bond prices has gone down so much is because of credit concerns. I don't think so. Most likely the decline in muni bond prices is due to the spike in interest rates. Because when you look at what bonds of any kind have done in the past month or two, well, muni bonds have fallen no more and no less than any other kind of bonds. So the problem with munis is not so much a credit quality problem, I believe, but an interest rate problem. Now, does that mean that local governments have nothing to worry about? No, but the likelihood that local governments may collapse seem overblown. Internationally, we have the concern of Europe. On one hand, we have the peripheral countries having to pay higher and higher interest rates to finance their debts, severe fiscal contraction in those countries due to the contractionary policies in place, and a pretty big decline in confidence that any of those small countries will avoid default. On the other hand, we have Germany, which is blazing ahead with great growth, great numbers, lifting the whole area. So there is a two-speed thing going on, and the question is which side will eventually prevail. The worst-case scenario is that the Eurozone breaks. That would be terrible, but sustained growth in Germany can go a long way to pull every other country in Europe out of recession and prevent a major disruption. So the key, as I see it, is growth. Politicians are fond to say that we cannot grow ourselves out of our problems. Well, I disagree. I think that we can. Growth will raise local government revenues, will bring down the rate of increase of debt, and we buy time before the market gets too concerned with problems here and abroad. This is a time when economic growth and equity prices are highly correlated. This is not always the case, but now it seems that if we can consolidate growth in the first quarter or two, then we will reduce the possibility of a market negative event and clear the way for 2011 to be the year when we finally pull away from the crisis that started 3 years ago. If that is the case, asset prices and equity prices in particular could be higher still. For more information, please visit us at www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.